California oil refiners have seen a notable increase in their profit margins, with gross profits per gallon rising to $1.01 in May, according to the California Energy Commission, CEC. This marks a significant jump from 43 cents per gallon in January. Retail margins, which exclude wholesale transactions, have also climbed to $1.05 per gallon. These figures reveal that refining and distribution now account for 38% of the total cost of a gallon of gasoline, surpassing the 35% attributed to crude oil costs. State taxes and environmental fees make up the remaining 23% of the price at the pump. This surge in margins has sparked concern among consumer advocacy groups, such as Consumer Watchdog, which warns that the high profitability of refiners is adversely impacting California consumers. The organization emphasizes the need for legislative scrutiny, especially as refiners are poised to dominate the market further, with projections indicating that 4 refiners will control 98% of California's gasoline production by April 2026. The state's Energy Commission is urged to finalize a price gouging penalty rule to prevent potential consumer exploitation. Meanwhile, Valero Energy's CEO has highlighted that global low inventory levels are supporting these elevated margins, indicating a continued trend of high profitability for refiners.
In a significant policy announcement, U.S. President Donald Trump has declared the imposition of tariffs on auto imports, setting rates between 15% and 50%. This move is part of a broader strategy to establish so-called reciprocal tariff rates, with the minimum threshold for these tariffs notably increasing. The decision is positioned as a response to what Trump characterizes as unfavorable relations with certain countries, which he did not specify. The tariffs are set to be implemented by August 1st, reflecting a continuation of Trump's aggressive trade policy approach aimed at protecting domestic industries. The announcement is likely to have wide-reaching implications for international trade relations and the global automotive industry. Major car exporters to the U.S., such as Germany, Japan, and South Korea, could be significantly impacted, potentially leading to increased vehicle prices and strained diplomatic ties. For U.S. consumers, this could translate into higher prices for imported vehicles, affecting purchasing decisions and potentially shifting demand towards domestically manufactured cars. The move may also prompt retaliatory measures from affected countries, further escalating trade tensions and impacting global market sentiment. Investors and companies within the automotive supply chain will need to closely monitor developments and adjust strategies accordingly.
Meta Platforms, Inc., Meta, is at the center of a bullish investment thesis driven by its advanced AI infrastructure that enhances its advertising platform's revenue growth and margin expansion. Despite trading at $704.81 as of July 22, 2025, with a trailing P/E ratio of 27.55 and a forward P/E of 27.93, the company's AI capabilities have not yet translated into consumer-facing products. This lack of consumer visibility contrasts with competitors like OpenAI, which have successfully captured end-user engagement. Meta's AI advancements, particularly in campaign optimization, offer a potential 50 to 100% improvement in results, but organizational silos hinder integration across research, model building, and product teams. In response to these challenges, CEO Mark Zuckerberg has initiated a strategic reset, investing $15 billion in Scale AI and acquiring talent from leading AI firms to unify efforts and develop consumer-facing AI products. The success of these initiatives could significantly enhance Meta's market position by leveraging its vast user base across platforms like Facebook, Instagram, and WhatsApp. However, the risk remains that without effective execution, Meta could be relegated to a back-end role in the AI era, while competitors secure consumer loyalty. The company's stock has appreciated by approximately 23% since May 2025, reflecting investor optimism about its AI-driven ad growth, but execution risks persist in realizing its full potential.
The financial spotlight is currently on 3 AI stocks: Upstart Holdings, UPST, Applied Digital, APLD, and AlphaWave IP Group, AWEVF, which are being touted for their potential to deliver five-fold returns. These companies are positioned as high-risk, high-reward alternatives to established giants like NVIDIA, NVDA. which, due to its massive market cap, is less likely to offer multi-bagger gains. Upstart Holdings is leveraging machine learning to revolutionize consumer credit underwriting with recent expansions into auto refinancing and home equity lines. Analysts project a significant revenue increase for Upstart, potentially accelerating with any rate cuts, highlighting the company's promising trajectory in the AI-driven financial services sector. Applied Digital, on the other hand, is capitalizing on the AI boom by transitioning from crypto mining to data center operations, focusing on facilities capable of supporting AI training. The company's strategic 15-year lease with CoreWeave for a substantial data center project in North Dakota underscores its growth potential. With ambitious revenue targets and a substantial increase in stock price over the past year, Applied Digital presents a compelling, albeit risky, investment opportunity. AlphaWave IP Group is making strides in the semiconductor industry by addressing the growing demand for high-speed connectivity in AI applications. The company's focus on chiplet architectures and advanced packaging positions it favorably within the rapidly expanding AI market. With strong financial growth and a strategic position in a burgeoning sector, AlphaWave is poised for significant expansion, contingent on sustained AI market growth. Collectively, these companies highlight the dynamic opportunities within the AI space, offering substantial growth potential for investors willing to navigate the inherent risks.
Labadin Keller Suturo LLP has filed a securities class action lawsuit against Fiserv, Inc., a prominent provider of payments and financial services technology, along with certain of its executives. The lawsuit, brought on behalf of the City of Hollywood Police Office's retirement system, alleges violations of Sections 10b and 20a of the Securities Exchange Act of 1934 and SEC Rule 10b-5. It claims that Fiserv misled investors regarding the performance and future prospects of its Clover platform, a significant growth driver for the company. The suit covers individuals and entities that acquired Fiserv common stock between July 24, 2024 and July 22, 2025. The allegations suggest that Fiserv's reported growth was artificially bolstered by forced migrations from its older PayEasy platform, which led to significant merchant attrition and a slowdown in growth metrics. As these issues became public, Fiserv's stock experienced notable declines, particularly on April 24, May 15, and July 23, 2025. This has raised concerns about Fiserv's competitive positioning and future revenue streams, especially in the context of its transaction processing software for banks and retailers. The lawsuit's outcome could significantly impact Fiserv, potentially leading to financial penalties and changes in its executive leadership if the court rules against the company. Additionally, the case underscores the importance of transparency and compliance with securities laws for publicly traded companies. Investors and stakeholders are closely monitoring the situation, as it may affect market sentiment and investment decisions regarding Fiserv and similar financial technology firms.
Neogen Corporation is facing a class action lawsuit filed by the law offices of Howard G. Smith, alleging securities fraud. The lawsuit targets investors who purchased Neogen's common stock between January 5, 2023 and June 3, 2025. The legal action stems from significant financial disclosures by Neogen, including a $461 million non-cash goodwill impairment charge related to its acquisition of 3M Company and subsequent revisions to its revenue and EBITDA guidance. These revelations have led to substantial declines in Neogen's stock price, notably a 28.7% drop on April 9, 2025, following further revenue declines and a CEO resignation. The complaint accuses Neogen of making materially false or misleading statements regarding its business operations and prospects, particularly concerning the integration inefficiencies with 3M. This has allegedly resulted in adverse impacts on capital expenditures, revenues, and EBITDA margins. The ongoing legal proceedings could have significant implications for Neogen's financial health and investor confidence, as the company grapples with internal control weaknesses and strategic challenges. Investors affected by these developments have until September 16, 2025, to file a lead plaintiff motion in this case.
California State University, Cal State, is grappling with a significant budget shortfall of $2.3 billion. Despite implementing a 6% annual tuition increase and receiving state taxpayer support. This gap, which excludes billions in building maintenance backlogs, is a substantial portion of the system's $9 billion operating budget. The financial strain has led to staff reductions, course eliminations, and a 3% cut in state support amounting to $144 million. These challenges were discussed at the recent Cal State Board of Trustees meeting, highlighting the need for immediate financial sustainability measures. The university system has been offered a zero-interest loan to mitigate the state funding cut, but concerns remain about its ability to maintain current operations and expand student enrollment. Governor Gavin Newsom's delay in fulfilling a promised 5-year funding compact has exacerbated Cal State's financial woes. Only 3 years of the anticipated $1 billion support have been funded, with the fourth year now spread over 2026 to 2028, leaving the fifth year uncertain. This funding uncertainty has strained relationships with unions, who argue that the system's financial constraints should not affect agreed-upon raises for its employees. The California State University Employees Union, representing 35,000 members, is advocating for guaranteed funding through legislative or ballot measures, as Cal State's cash reserves are insufficient for long-term operations. The situation has drawn criticism from lawmakers and union leaders, emphasizing the need for a sustainable financial strategy to support Cal State's 460,000 students and its largely low-income demographic.
GoPro Inc., NASDAQ. GPRO has emerged as the latest focal point in the ongoing meme stock phenomenon, following in the footsteps of AMC Entertainment and GameStop. Over the past week, GoPro's stock has surged by 98%, driven largely by speculative retail trading and social media hype, rather than company fundamentals. This trend reflects a broader market dynamic where stocks experience heightened volatility due to short squeeze pressures, a situation where short sellers are forced to buy back shares at higher prices to cover their positions, thus propelling the stock price further upward. Despite the recent surge, GoPro's financial health remains precarious, with the company struggling to maintain profitability amid declining revenues and stiff competition. The company's stock is still down 69% over the past 5 years, highlighting the disconnect between its current market performance and its underlying business conditions. Analysts have issued a consensus rating of strong sell for GoPro, suggesting that the current rally may be unsustainable and cautioning investors about potential pullbacks. This speculative trading environment underscores the risks associated with meme stocks, which can experience rapid price fluctuations that are often untethered from the company's actual financial performance.
Wolfspeed Inc., a semiconductor company, is navigating a Chapter 11 bankruptcy restructuring with the assistance of Apollo Global Management, which has extended a financial lifeline in the form of a $1.25 billion secured note and an option for an additional $750 million. This move comes as Wolfspeed grapples with a significant drop in stock price from the $7.50 range to below $1 following the bankruptcy announcement in May. The restructuring plan involves appointing turnaround specialist Gregor Van Issum as CFO, refinancing existing debts, and significantly reducing current shareholder equity. The company, formerly known as Cree Inc., refocused on semiconductor manufacturing in 2021, specializing in silicon carbide and gallium nitride chips, crucial for the growing AI and tech sectors. The restructuring has polarized analysts and institutional investors. While some remain optimistic due to the rising demand for Wolfspeed's wide bandgap chips, others are concerned about the company's ability to overcome its $6.5 billion debt. Notable bearish investors include T. Rowe Price and Jana Partners, who have significantly reduced their stakes, while bullish entities like Vanguard Group and Goldman Sachs have increased their holdings. Analysts have set a 12-month price target ranging from $3 to $10, with a consensus around $6. The current stock price of $1.80 suggests potential upside, but the path to recovery remains uncertain given the company's financial challenges and market conditions.
Mastercard has launched an AI-powered card design studio, enabling card issuers to create and deploy card designs more efficiently. This platform allows users to upload logos and product details, utilize AI-assisted design features, and produce brand-compliant designs in minutes, significantly reducing the time from weeks to minutes. The new tool aims to enhance creative flexibility and emotional impact, transforming card design into a more dynamic and inspiring process. Cheryl Guerra, Mastercard's EVP of Global Brand Strategy and Innovation, emphasizes that this tool represents a significant advancement in how cards are conceptualized and produced, offering powerful capabilities directly to partners. This development comes as Mastercard simultaneously extends partnerships with major companies like Uber and American Airlines, indicating a strategic focus on strengthening collaborations. The introduction of the AI Card Design Studio could bolster Mastercard's competitive edge by offering a unique value proposition to banks and card issuers, potentially influencing market dynamics in the card issuance space. Meanwhile, amidst a challenging economic environment, subprime consumers continue to rely heavily on credit, with 25% using credit for essential expenses. This highlights ongoing opportunities for financial institutions to cater to this demographic, despite the broader economic uncertainty characterized by persistent inflation and shifts in consumer spending behavior.